The threat of recession in the Western world is now greater as central banks and governments raise interest rates to quell inflation before it takes a hold and saps wealth creation. But if economies buckle under the weight of those higher interest rates, governments may well be forced to be this time limited in their response, having borrowed so much money to avert greater economic damage caused by COVID. This week, I caught up with James McCormack, Managing Director and Head of Sovereign Ratings with Fitch, who was in Australia for a global conference. James McCormack, many thanks for your time. Can I just start with the state of preparedness of Western governments to cope with a second economic downturn so closely on the heels to the pandemic-inspired recessions that they had? Now with interest rates rising, inflation rising, what sort of state are they in to cope with another downturn?
Not the best state, shall we say, the obvious. I think the biggest challenge for governments looking ahead in terms of the challenges that they could face is really government debt. So government debt, we've had a ratcheting up of government debt, not just from COVID, but we can even go back to the global financial crisis. So global financial crisis, debt moved higher. There was an interim period, Eurozone crisis, debt moved higher. There was an interim period when economic growth was quite strong. There wasn't the kind of fiscal consolidation that would bring down debt to GDP ratio, so government debt stayed roughly flat. Then we're confronted with a challenge like COVID, debt moves higher, and now potentially a downturn in growth again. And we've got very high debt levels. So interest rates have been low throughout this period, but now we could be at the turning point in terms of interest rates. That's maybe a 40-year turning point. So governments are going to be facing higher debt burdens with higher interest rates. Not a great combination. So
the former Treasurer and Prime Minister of Australia, Paul Keating, called the early 1990s recession here, which was deep, the recession we had to have. Is the world now facing a recession it has to have because these debts have not been addressed?
Yeah, I mean, that's an interesting way of thinking about it. I'm not sure that government officials would agree that this is a recession that they have to have. Look, there's other ways to bring debt levels down. This is just going to bring debt levels up, right? This is not going to correct a debt problem. Interest rates are going to be moving higher. I think that's the big difference with this particular, at this juncture, shall we say, because previously you could count on a loosening of monetary policy, a loosening of fiscal policy. But now we're going to have monetary policy being tightened. And what do the fiscal authorities do with that tighter monetary policy? And I guess you can see in Europe that there's a struggle in terms of what the ECB is going to do, because we've got this challenge with peripheral countries where interest rates are already moving higher and the central bank hasn't reacted yet. So challenges all around in terms of getting policy coordinated between the central banks and governments.
So Andrew Bailey, the Governor of the Bank of England, talked about the narrow path that his central bank is on to basically create a soft landing without having the economy, as interest rates rise, drop off into recession. This is the struggle that every central bank in the world confronts right now.
And the track record isn't good. So usually when policy rates are rising, the idea is to suppress demand. And when you suppress demand, you're going to get slower growth. It's the question of how slow is that growth going to be? And typically that leads to recession. So if you look at sort of previous interest rate hiking cycles, not very often have central banks been able to do that and avoid recession. So in our view, the U.S., for example, is going to be skirting recession, not this year, but in 2023, because the Fed is going to be raising interest rates this year. Household balance sheets are still relatively strong. Employment growth is strong, as it is here. Wages are moving higher, as they are here. So households are still in reasonably good shape. So it's hard to see a recession with that backdrop. It's into next year when interest rates are higher. Still, some of those household benefits may be sort of wearing off. Wage gains may be not so high, and real income starting to move lower. And then you get perhaps a reduction in consumption and weaker growth.
one difference between today and go back to the early 1990s is that there is a significant demand for labour right now. Unemployment rates are very low. Households, generally their balance sheets are in pretty good shape compared with the government's perhaps. The issue is whether that's enough of a buffer to prevent the rise in unemployment that leads to the collapse in housing markets, which leads to problems inside the banks.
Here in Australia, I think it is in the short term, but like most developed countries, the labour market is fed by immigration, right? So there hasn't been much immigration during the COVID period, hence you get this tightening of the labour market. That's a phenomenon that we see around the world, but here it has made a big difference in terms of the labour market here. So what we call the participation rate here in Australia is actually quite high. In the U.S., participation rate has actually dipped. So people have left the labour market during COVID and may come back. Maybe they won't come back. That hasn't been an issue here. People haven't left the labour market in the same way. So it's fundamentally tighter labour market here. So which means you could get upward movement in terms of wages, but you still need the labour market to be able to grow through immigration in order for the economy to grow. So that's a challenge.
Okay, then take me to next year. You talked about this year being okay. Next year is where the challenge lies. What does the world look like? What is the broad assumption? Because some are even saying now that central banks may really cause their economies to slip off the path into recession potentially. And as a result, even by the end of next year, the US Federal Reserve, the Bank of England, the ECB may very well need to start bringing interest rates down in response to their slowing economies.
Yeah, look, there's a number of analysts who think they're going to bring interest rates down even before that, because economies are going to begin to slow before the end of next year. That could happen towards the end of this year. U.S. economy didn't grow much in the first quarter, not entirely clear about the second quarter either. So the weakness in growth could come earlier than that. But in our view, the recession risk is really a next year risk because the labor markets are tight and households are still reasonably strong. So the issue is into next year, those higher interest rates to combat inflation, we think, are going to have a bigger impact because central banks have miscalculated, I think it's fair to say, and most central banks would acknowledge this themselves, just how persistent inflation was going to be. And that leaves them a little bit behind the curve in terms of raising rates. Now they've got to be more aggressive in raising rates. So our view is that interest rates definitely move higher and that economic activity is going to be impacted by that, but it's probably more into next year than this year. So recession is a real risk.
Okay, so recession's a risk, but then many would say that this is as a result of the catalyst of Russia invading Ukraine, which has sent energy prices through the roof. There's a second factor also, and that is during the COVID recessions, massive amounts of money were printed and or debts taken on by governments to try and make certain their economies were given that soft landing. So both things work hand in glove, don't they?
Yeah, look, growth was slowing towards the end of last year and into the first quarter of this year. So it was before the war broke out in Ukraine. So we already started to see the slowing of global growth. And that's evident in virtually every region that we cover. So all the emerging market regions and in developed markets. So growth was already winding down. The recovery from COVID, where we had sharp increases in growth, had already started to fade.
Australia right now is one of only 9 countries in the world to have a AAA credit rating from the 3 ratings agency, including yours, Fitch. So tell me about Australia as a place to be for these next few years as the world goes through these ructions.
It's good to be a commodity exporter. So that helps enormously. But to be fair, the policy response here to COVID was quite impressive. So the fiscal response was good. Being surrounded by the sea was helpful in that you could isolate Australia in ways that European countries found very difficult to do. Keep COVID out, get the vaccination rates up, so that when you open up, most people are vaccinated. So, look, I think from where we sit, the primary issues around the rating are focused on government debt levels, and whether we think that's sustainable. Government debt here is clearly higher than it was pre-COVID, higher than it was 5 or 10 years ago, considerably so. But we had a negative outlook on Australia when we were concerned that the debt to GDP ratio was going to continue to escalate. Now we see it hovering below 60%, and we're pretty convinced in the medium term with solid growth numbers, driven in part by the commodity story. We think that debt to GDP ratio can level off and start to come down.
And one final thing, how important long-term is it for a government to get its budget back into surplus and not to run ongoing deficits for year after year?
Look, governments can run deficits and debt to GDP ratios can still fall. So we're more focused on the debt level than we are on the annual budget, because debt dynamics depend on a number of other things, how fast the economy grows, et cetera. So it's important. It would certainly drive debt lower more quickly. Hard thing for governments to do, and if they're focused on debt as we are, not entirely necessary for that to bring the debt ratio lower.
James McCormack, many thanks for your time.
Thank you.